Okay. There was somebody in the chat. Let's see what that is. Okay. All right. So now I'm going to go into week 2. And here we are. You should be able to see my screen. So today it's going to be financial statements and their elements. All right. So in financial statements, if you've been watching, if you took the chance, and I hope you did, to watch my videos and look at my interactive spreadsheet, hopefully that gave you a good feel for what the statements are. It gave you a good refresher. But there are 4 elements of the financial statements. And what they do is they tell us the profitability of a company. We could do ratio analysis. We use the statements to see whether we want to invest in a company or whether a company has enough resources to acquire another organization, sell off its divisions that are underperforming, or whether to increase its labor pool. These are all ways. These are all ways where we could use financial statements. So, okay. These are all ways where we could use financial statements. Once again, if you go back into the classroom and go back to my work, you could watch my videos on all 4 statements. But basically, the income statement is telling us what we made for the year. So if somebody could just speak in the mic and tell me that you could see my screen, I would appreciate it.
We can.
Yes, sir.
I can see it.
Excellent. Excellent. So you could see where in this particular company they have service revenue. This is a simple income statement. And you're taking out expenses, and that's going to tell you what you made for the year. And that's what the income statement does for us. It basically tells us what we earned, and we apportion the correct costs against what we needed to do, what we used in the firm to make those revenues. So for instance, if you had a business, like a huge business, like say for instance, Coca-Cola, big business, right? Many divisions, and I'm just going to make it simple. You have regular Coke and Diet Coke and all these different, and you have all these different brands. You can't just put any cost you want of Coca-Cola. And then maybe I do the rest as I move along, Well, there are other brands. But at the end of the day, we're going to have one income statement, and the income statement tells us how the firm performed that year. Then we have a statement of retained earnings, which means that after the company is profitable, something has to happen with that money. Now, after your year is closed and you have a profit, you could do 2 things with the profit. You could either put the money back into the company, that's retained earnings, or pay a dividend out to shareholders. And that's why we have this statement, because it tells us whether we're going to put the money back in the company, okay? We're going to put the money back in the company, or we're going to pay dividends. So your statement of retained earnings is going to give you that kind of look. that kind of detail. Okay, that kind of detail. You're going to get that from your statement of retained earnings, which again, the statements that we're looking at here are relatively simple. I'm not going to lie. They're not heavy duty statements because they're basically here to, just give me 1 second. They're basically here to give you an example. Now, the balance sheet tells us what the company is worth. So on the left side of the balance sheet, you have all your assets, and they start with the most liquid, like cash and accounts receivable, and they go to the most illiquid, like equipment and buildings and grounds. And then on the right side, you have what you owe, your loans. When I take what I own minus what I owe, I'm getting what I'm worth. So the basic accounting equation is assets minus liabilities equal equity. Now think about it for yourself personally. You might have your own personal balance sheet where you have a value to your home, you have a value to the cars you drive, you have a value to collectibles, whatever you own, stocks. But then on the right side, you might have a mortgage, a car loan, maybe some credit card debt, something like that. But when I take the long side minus the liabilities, I know what I'm worth now. So that's why we pay attention to the balance sheet. So to recap, and the cash flow reconciles all cash. It's probably the most difficult one to understand. We'll talk about that. But these statements give us a good snapshot of what the company is doing. And preparing financial statements means that a CPA has to come in, a certified public accountant, and it's difficult. To get that CPA is not an easy thing. It's one of the more difficult tests that we have in this country. We should have to know so much. But the CPA for any individual, and every industry has their own particular stuff. For instance, if you're in the oil industry, oil driller, well, you're going to have to deal with things like depletion. You're taking oil out of the ground. It's got its own kind of idiosyncrasy. If you're dealing with a service industry, it's a little different. If you're dealing with agriculture, it's a little different. The basic principles are the same, but you do have differences. And all of that is all the way you handle these differences or the way you handle all of the possible ways to account is according to GAAP, generally accepted accounting principles. The key word for this week, or the key words, will be generally accepted accounting principles. The key words for this week, generally accepted accounting principles, which if you're going to go in the accounting business, that's your Bible. That is your Bible. That's how you figure out how to treat different financial situations on your books. Generally accepted accounting principles. And you could use these examples when you're completing your assignment. This would be your income statement. This would be your balance. This would be your statement of retained earnings. Here's your balance sheet. Notice that balance sheet. Use these for your assignment, but I gave you an example, by the way. Notice here's all your assets. They total up here. I don't like the way they did this. They should have did two sides, but you could do it this way too. Here's what you owe. And notice when I take this from this, I get $17,000, and that's the value of my company. But remember, these have to balance. But 24 minus 7 equals 17. And then this is my statement of cash flows. Because my statements tell me one thing. My cash flows might be a little different because remember, for instance, if I build a building, I got to take cash out to build a building, right? I got to take cash out. That reduces my cash, but it increases my building. Now, I still have the same amount of assets. Let's say I'm a firm with $1 million in assets, and I decide to take 500,000 of it and build a new factory. Well, I'm going to be $500,000 less cash, but I'm going to have a $500,000 factory to make money. Now, that's a good thing. But as far as the cash flow is concerned, I've reduced my cash. And so we need to understand that because a firm has to run on cash the way you have to run on cash, right? You might have $100,000 in the bank. I just had this conversation with a son of mine who's buying a house. He's getting married. He's going to buy a house. and he put some money away, and he's got his 401k. He's an attorney. I mean, they're starting out, and properties have gotten so expensive, as we all know. And his fiance is in a similar position. And he said, well, if we take some money out to put a down payment, we're using our equity. I said, well, listen, Andrew, you got to think of it this way. You're debiting cash, which means your cash flow, your statement of cash is less, but you're getting an asset. So it's not like you're taking the money and throwing it in a casino. Not like you're taking the money and burning it. You're transferring cash into an asset. But as far as the statement of cash flows is concerned, your cash has gone down a bit. And you need to pay attention to that, because you don't want to be in a position where you have a house or you have stocks, but you don't have cash. Cash is king. You need to pay your bills. You look at a company like Bed Bath & Beyond. They were a good company. I mean, I'm not a big shopper. I like to shop for food days. I like the supermarket. Not in love with going to regular shopping, but I take my wife, love her to death. And, we used to go to Bed Bath & Beyond. There was one right near us, and I thought it was a pretty good store. Had a lot of good things. You needed something, they had it. Matter of fact, recently we wanted to buy a little Fry Daddy. I don't know if you know what a Fry Daddy is. It's one of those little things we had one years ago. We didn't have it. My wife said, I can fry our own. But, we went on a trip to Italy, and they made these little like shrimp and everything and zucchini. And she said, I'll just get a Fry Daddy. I can make it. We do have a place that's nearby that fries fish, but she said, oh, they use cornmeal. I'd rather just do a little flour. All right, whatever. And normally we just go to Bed Bath & Beyond and get it. But that doesn't exist anymore. So we ordered it on Amazon, obviously. Not obvious. That's how we did. But the reality is, Bed Bath & Beyond would still be around if they don't run out of cash. So you have to stay with cash. You have to have your cash position. And that's why we watch that. And then finally, we have our income statement. So you could use these to do your, and then do the interactive
Today,
experience.
you're helping Kennedy prepare financial statements. You're assisting Kennedy, abutting off from each of the accounts.
And you have to
use the slider in each cell to
So
determine.
I'm going to leave that up to you. Okay, I'm going to leave that up to you. Any questions? Now's the time to ask questions. Any questions? Look, we've got a good crowd today. Any questions? Any questions out there?
No, sir, not today, but I'll message you later if I need any help. Anything.
Please just say that a little louder.
I said, no, sir, not today, but I'll message you if I need any help or anything.
Okay, so you have no questions right now. If you have any questions, just send me a message.
Okay.
All right, thank you, Shanti. Thank you.
Yes,
And you guys-
thank you.
Yeah, and I'm great at your first week's work. It was very good. I gotta tell you. All right, so let me share my screen. Let me go back. Just tell me if I'm not sharing my screen. Right now, I should be sharing my screen. And we're gonna go back here to module 2. And let's look at the assessment. So the assessment is you have to create a business memo for Alex, our friend Alex. And I also put a video from the previous week. So of course you're going to have this video and a video from the previous week. But since I have all the videos, I include them sometimes. It's just another one you could watch. Let me just make sure I'm sharing my sound, because this is another headache with this Microsoft.
It was just
Excuse me?
you just had it up a few
Yeah,
seconds.
I'm going to put it here, but you see what you have to do? You have to also make sure you're sharing your audio. Times that'll.
Okay.
Yeah, yes. Thank you for telling me, by the way. It'll screw everything up. All right, let's listen to our friend Alex. He's a nice guy.
Hi, it's Alex again from Ground Up Cafe. Thanks to your advice, I was able to choose the best structure for my business. And now I've officially launched. I just wrapped up my first quarter, and I've been keeping track of important transactions like purchasing equipment, paying wages, and making sales. Here's where I need your help. I want to understand how these transactions affect my cafe's finances. For this assignment, you'll use my records to complete the accounting equation and then prepare the 4 key financial statements: the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. I'd also like a short memo from you explaining the purpose of each statement, why they need to be prepared in a specific order, and how they connect to one another. With your guidance, I'll be able to clearly see where Ground Up Cafe stands after its first quarter and plan confidently for what's next.
All right, so Alex, good guy. You need some help. And you will continue your role as an accounting advisor to Alex. Alex has launched a cafe and completed the first quarter of business. He has recorded transactions such as coffee, bean purchases, wages, and cash sales. Your job is to show Alex how these transactions are reflected in the accounting equation and prepare these 4 financial statements. So you do have a template. You're going to call that up. And then you have to complete the accounting equation for the 6 transactions. So one is he invests $50,000 in his cafe. Obviously, that's an increase to equity. He's going to purchase equipment for $15,000. That's a debit to cash and increase in assets. He's going to purchase inventory again, but it's on credit. So that's an accounts payable. He made some sales, so that's on your income statement. And he paid rent and paid wages. That's also on your income statement. And you have to prepare these 4 financial statements: the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. And then remember, you have to write the memo. So to get full credit, you have to do 2 things. You have to, by the way, generally accepted accounting principles is the key phrase for this week, the code word, whatever you want to call it. So anyway, you got to prepare the memo, and you have to do the. So it's 2 things you have to give me. You have to give me the memo, and you have to give me the. You have to give me the memo, and you have to give me the. You have to fill out the template. Okay, it's a file upload. So far, you guys done a great job, so I'm not worried about it. Let me see something. I don't like that there's only 1 attempt. So I'm going to give you unlimited attempts. Just in case you have to attempt again, okay? All right, I'm going to give you unlimited attempts. All right, so let's go back. And, okay. And let's go to the assessment. And let's start by looking at my example. So you're going to click on this example. And when this example comes up, now these examples aren't meant to do the homework for you, even though it helps a lot. They're meant so you can understand. Instead of spending a lot of time trying to figure out what goes where, I want you to put it in your own template and then explain it. That's why I do this, to make your life, to make your life easier to some extent, but also so this way you do a more effective job in understanding what we're doing here. So here the owner invests $50,000. Now what happened there? The owner invests $50,000. Notice you have $50,000 in cash and $50,000 in capital, and that raises that asset. Then you buy equipment for $15,000 cash. You've increased equipment by $15,000, and your assets increased by $15,000. Then you're going to buy $6,000 in, what is this? You're going to buy inventory for $4,000. There's $4,000. $4,000 is on the liability side because you borrow the money. Then you're going to pay $1,200 for rent. Is that right? No, $6,000. I'm sorry. You sold $6,000. So you put cash in your account and you put $6,000 in. And then notice these last 2, where you had to pay for rent and wages, that's going to be a deduction on the wage side. They're expenses. Notice these are expenses. This is revenue. This is capital. These are assets. Okay. Now in part 2, everything should show up on your income statement if you did it correctly. So you made $6,000. You take out these 2 expenses. You have total expenses. Your net income was $2,800. On your statement of shareholders' equity, you started with 50 because that's what you put in. You put in an investment. You add income. You took some money out to pay bills. There's your equity. On your balance sheet, you have cash positive, inventory, positive. But you also had non-cash, which was equipment. There's your total assets. But then you took out a loan. Remember, when you bought the $4,000 of inventory, you took it as a credit to a company that gave it to you on credit, so it's accounts payable. When I take that, right? When I take what I own minus what I owe, I'm going to get my equity. Okay? And then finally, you have your cash flow position. So you had positive cash received from sales. Okay? Yeah, positive cash received from sales. You have cash you paid for rent. That's money that came out of your pocket. You have cash you paid for wages. So in terms of your operating activities, you did bring cash in this period, but you spent money on expenses. So you wound up with a net cash position of $2,800. Then you bought equipment, which had to come out of your pocket, so we have to deduct that. But you put money in, so that's a positive. Notice when you net these out, which would be 52.8 minus, you're going to have an ending cash balance of 67. Okay. Any questions on this?
Yes, I have a question.
Sure.
You said that you wanted us to do our own I guess the four different things, but aren't those the numbers that you gave us? So aren't these already correct? I know we
Yes.
still have to, okay, so on
Yes.
this part, we don't have to redo it. We just
No.
have to explain how
Right.
each one is important to the company.
It's an
Okay.
excellent question, Angela.
Okay.
Yeah. And you know what my theory is, and I've been teaching this class a long time, and they obviously students like it and the administrators like it. So my feeling is this: my first degree, just to give you a little history. I mean, I'm going to be 68 in a blink. But when I went to St. John's back in 1976, I started as an accounting major and a economics major. So that's how I started because I wanted to learn accounting. I figured if I'm going to be in business, I have to learn how to sheet the accounting words. So I know how painstaking it could be. Now, in a curriculum like this, you're not necessarily going on to your CPA unless you are. You should let me know. But if you understand how to do it, you hit the nail on the head. Explain to me what these statements mean, or explain to Alex what these statements mean, and use my guidance to just fill out the form. How's that sound?
Thank you so much. That
No.
helped me understand a little better.
No, but
Yes, thank
I,
you.
and I know sometimes you hate to say, well, I'm giving you the answers. I'm not really giving you the answers. I mean, we could spend a lot of time, putting, X's and O's and people getting wrong, and it's frustrating. I just think it's a waste of time. I think your time is better suited, recreating, using my numbers. Because remember, sometimes when you have to look of it this way. Here's how I see it. Let's do something that you probably all know about, cooking. You have to cook. Now, I wonder, how'd you learn how to cook? Probably whoever cooked in your house, probably your mother, it could have been your father, it could be anybody. You watched them as a kid. You said, oh, that's how you do it, right? That's how you do it. Or your father, did so, I know my house, my father, like, if you did fix the toilet, you watched them do it. Then at one point, they said, no, you try it now. Now, they just showed you what to do. No, you try it now. And that's how you learn how to do it. And that's, I guess, how I'm looking at this. Or maybe the person who cooked said, all right, I just fried these 3 pieces of chicken. Now you try it. And then you took to do a couple, and now you learn how to do it. Because if they're teaching you, that's how they're going to teach you. And I think that's how I approach accounting, It's very much like a task. It's not, it has to be done a certain way. And I'm showing you how to do it, and now you go ahead and do it. Does that make sense? And you use my template to get it done.
Yes, it does. Thank you.
Okay,
Very
good.
helpful.
Thank you. So then, but make sure your memo kind of explains what we've been talking about. That's important. That's important. All right. So good. I'm glad. I'm glad we spoke about it. You know, I can understand where you're coming. So that would give you, we have the account. So, oh, by the way, remember, I have this accounting playlist. So if you want to go back, some of you, and say, and or people watching at home, and say, you know what? I'd like to really go over these again. These are short videos I created. They're like 7 or 8 minutes. You can watch these again, and there's your spreadsheet, so you can actually work it through and see where these numbers are coming from. But and there's your business memo. So let's take a look at the business memo. Again, with the business memo, I'd rather you kind of put it in your own words and write a good memo. It's part of it is to show us that you know how to. Part of it is to show us that you know how to write a memo too. So, let me make this bigger. All right. So this memo explains the purpose of the main financial statements, why they are prepared in a specific order, how they are connected, and how they help you make better business decisions. The goal is to present this information to you clearly, and then we explain the 4 financial statements quickly. And these statements must be prepared in order because each one relies on information from the previous statement. The income statement is prepared first because it calculates income. Then you do your balance sheet. Then you do your retained earnings because you have to know what you made to have retained earnings. And then finally, you reconcile cash flow. Now, the one that's probably most, so you just put it in your own words. And we want to see that you could write a memo because because in the real world, that's what we're going to ask. That's probably what they're going to ask you to do. Okay. Now, one other thing. The statement of cash flows could be the trickiest one. So I want to go over one video with you. Statement of cash flows could be a little tricky. So I want to go back. And review that one more time. The other ones are pretty cut and dry, I think. And you can watch these on your own. But since we have a little extra time, I'd like to do this together. Bear with me. Finally, we now come to part 4. I don't know if it's part 4 or part 5, but it's a statement of cash flows, which is really important if you're going to study finance. Remember, accountants are going to mostly be concerned with what they have to report to the IRS and presenting clean financial statements, which is the income balance sheet, the income statement, retained earnings is part of that. And that's very important because you do not want to make a mistake on or intentionally make a mistake on any of your financial statements, because that could carry civil and criminal penalties, as we know. And we're going to go over it, my last piece, where I go over the qualitative aspects of accounting or these particular financial statements. But the statement of cash flow is a little different because it's what the finance people are interested in. It's how much cash is actually in my pocket. Like, for instance, if you're writing a check for your mortgage every month of, say, $2,500, and that's the check you write to the mortgage company. Well, one way to look at it, most people will probably look at it as, well, it cost me $2,500 to live in this house. But here's the reality. If you're getting a deduction on your taxes and on your, which you do, on your taxes and your mortgage, depending on what state you're in, your income level, if you're getting that, because now we know with the new tax law you can get a high standard deduction, but let's assume an important one. They don't deal for it. We don't deal with it as much in the class as I'd like, but depreciation is a big number in accounting. When you have a company and you buy a building, say for instance you put $1 million out for a building, the government, meaning the IRS and the government, they allow you to write that building off. So you could write it off, say, over 10 years. And each year you could reduce your income by $100,000. The reason is they want you to build a business. The government is not trying to penalize you. They're going to encourage you. Believe me, when I tell you, and this is why you come to school, right, to learn the things that they don't teach you in the book. The government wants you to build a business. The tax code is very favorable to people who build businesses, because when you build a business, you hire people and they pay taxes, and the economy grows, and that's how a country grows. So they want businesses built. Don't get me wrong. And one of the ways they encourage businesses with depreciation. So you get $100,000, you could take it off your income. So think it out. If on that particular year you had $1 million in revenue and you had to pay 30% taxes, you would have to pay $300,000 as a business. But since you had 100,000 in depreciation, you could reduce that bill to 900,000, and now you only have to pay 270. So effectively, the government picked up 30,000 of your IRS money, your taxes. Now, that's how depreciation works. The other thing why the government likes depreciation is they can encourage you to do things. So, for instance, I live in the state of New Jersey, right? I'm a New York guy, but I live like right over the border in New Jersey. But there's some areas in New Jersey that are very challenged, like Camden. Right? I don't know if you know the place, but it's been a challenged area. Now, if I decide to open up a business and locate it in an area that's, basically middle class, I'm going to get the regular depreciation treatment. But if all of a sudden I'll move it to Camden, they'll give me better depreciation. They'll say you can write it off over 5 years. And because the time value of money, anything I can get quicker is better than what I get later. Money sooner is better than money later. So depreciation is a way for the government to encourage me to do certain things. Like, for instance, when we had the AIDS epidemic, which was terrible, right? People were dying. It was just nobody knew what was happening. Even with COVID, they could use depreciation to get people to do things. Like, for instance, they can go to the pharmaceutical companies and say, if you spend money on research and development and on facilities to cure this thing, we will give you more accelerated depreciation. So depreciation is something where you can get the write-off, but it's not really a cash expense. And that's why you have to add it back to your cash flow. Because you took the money out. So as far as the books and records of your firm, it looks like it cost you 100,000, using my example, but it has to be added back so you could see that it wasn't really a cash outlay. Then notice if I do give people money to buy my goods, accounts receivable, that's got to be subtracted. If I take down my inventories, that's positive because I'm not carrying as much inventory. But if I borrow money, that's also positive because I'm using money to make revenues in cash. Remember, it's as of a certain date. But I didn't have to lay that money out. And this is why we reconcile cash flow. So let's continue. Assume you're writing off your mortgage and your real estate taxes. Well, just like going back to my depreciation video, you're getting a break from the government. You're taking income out of your IRS statement or out of your IRS filing, so you pay less taxes. In effect, if I'm paying less taxes, whatever my tax rate is the share that the government is kind of giving me a shield on. So if I had $20,000 of mortgage payments in a particular year, my tax rate's 30%. Effectively, I've saved 20,000 times 0.3, which is $6,000, because I didn't have to claim it. So try to understand that. Spend some time thinking about that, because it's really important. So if I'm able to shield 6,000 of my income, effectively the government picked up 6,000 because I would have had to write them a check for that. So your effective cash flow is increased at the end of the year by $6,000 is what I'm trying to say. When you get those refunds from the IRS, these aren't gifts from the government. They're just giving you back the money that you didn't take advantage of during the year. If you had taken your full deductions, you wouldn't get any money back. Remember, anything you pay into the tax system, if you get it back, that means you overpaid. That's all it means. When people get these tax returns back and they feel like they got some sort of bonus check. It's not a bonus check. I mean, get this straight. You gave too much money during the year, which is fine because you don't want to owe money. Don't get me wrong. You definitely do not want to owe money. So it's always a smart thing to maybe overpay and get a check at the end, because you don't want to find out, you wake up and you find out you got to write a big check to the IRS. That's not good either. That's not what I'm implying here. But what I am telling you is when you get that money back, it's the money that you shielded. So if you get money back because you had mortgage deductions, well, that's great, but that's cash flow that comes back to you because effectively you had it taken out of your check prematurely or over. But that's fine. But just understand what that number is. And that's really like the statement of cash flows. So here we know that 231,000 is the net profit that we had from our income statement. Right? Here it is. And 239,000 is the depreciation write-off. And remember, go back. Now I want you to go back. And if that doesn't make sense to you, I want you to review my video on depreciation so you understand that. What I'm going to do now is add back the depreciation. Just like I explained how you would add back the mortgage money that you didn't the deduction that you were able to take on your taxes and you got a refund. So that's what you're doing. You're adding back a non-cash expense. It's really important to stop there and think about it. Pause the video, go back to my depreciation video, and think about it. You are adding back a non-cash expense, something you were able to deduct from your taxes so you didn't pay as high tax. Depreciation is no different than your mortgage and real estate taxes. So take a minute, or if you own a business, write-offs. Take a minute and think about it, because this is really important. Okay, so we're adding that back. And then if we offered more credit to our customers in this particular year, well, it would be a negative, because effectively we've used our cash to make sales, and that comes out of our cash flow. So that's why we reduce our statement of cash flows when we increase our accounts receivable. If we had decreased our accounts receivable, it would be a positive, because we're lending less money. In this particular year, we use less inventory. So if we were whatever business we're in, auto dealer, computers, whatever, we carried less inventory. Well, if we carried less inventory, we needed less cash. So in this case, since we decreased our inventories, we added back our cash. If we had increased our inventories, obviously we would subtract. Now, again, in this particular year, we borrowed less money on a short-term basis from our suppliers. Our accounts payable is basically the accounts receivable from the other side. Whatever we use that particular year, raw materials, basically probably raw materials in this business. Well, we had people who supplied us with those raw materials, and they loaned us the money to buy them. Effectively, they gave us terms. We wouldn't have to pay. Remember I tell you about ShopRite? They sell the product that day and get cash, but they don't have to pay for things for 60 days, and that's how they make their cash flow. Well, here, since we increased it, we will add it to our cash flow. So these are two sides of the same coin, basically. We gave more credit to our customers, so we subtracted. We took more credit from our suppliers, so we added it. And then, if we had prepaid more expenses, remember I talked about accruals early on. If we that's why you got to watch these videos sequentially. If we prepaid our expenses, well, then it would be an addition. And so we would increase our accruals. So when we net all these things out, once again, I sum them up here so you have a little kind of free tutorial on Excel. I'm going to come up with the cash provided by our operating activities, which of these is 500. Now, in this particular year, we increased our gross fixed assets. What does that mean? We either enhanced our buildings. Let's say we were in a school and we put new technology in, or we built a new building, or we put in a new parking lot, or whatever we did. We bought a new series of trucks, a fleet of trucks. If we did all those things, that's money we had to spend to keep our business going. It's a capital expenditure. That's why when you watch economics and I always tell you, read the papers, and you see the capital the capital spending index. It's an important number because it tells us how much money companies are devoting to things that make other things, capital spending. And if they expect business to go up, they're going to increase their capital spending. In this case, this business obviously feels they're going to do more business. So they enhanced their building. They bought a new building. They increased, maybe they bought trucks. When they did that, they had to lay cash out. Now, that's an investment in the future. Obviously, they'll be able to depreciate those things at one point. But right now, it's money they spent this year. So we're going to subtract it. So take a minute, pause this, think about it. So we take that out. And finally, we have our financing activities. And that's the third part. So we paid off some of our loans. Think of it like when you pay off your credit card. So basically, if we paid off some of our loans, we had to lay cash out. So that came out of our pocket. Think about it like I've been paying off my credit cards or some sort of card debt that I had. Well, I would decrease my notes payable. But on the same token, I took out a long-term loan. Maybe I took out a longer car lease. Well, this would be the payment of the old lease. This would be, I increased my debt. So actually, I brought more cash in because I bring in more cash in when I take on more debt, but I paid off some of my old debt. And then I have 11,000 more in stockholder equity. I must have sold some stock during the year. That's what happened here. So I brought cash in by bringing in new partners effectively. I brought in new partners. And then remember from our list, retained earnings and income statement, I paid out dividends. So preferred of 10, I think it was 98 on common. So that had to come out of my final payout. So when I net these out, that's my cash provided by financing activities. So when I add this, I subtract actually, and this, and what I did was I did an add because I made these negatives. It's again another little free Excel tutorial. I'm coming out with 92,000. So that's my statement of cash flows. In this particular year, I brought 92,000 positive into my account. What I would do with this is I would spend a lot of time thinking about it, going through each thing, thinking about the concept, maybe related to your own personal business or your own personal financing, because this all relates. And any company, once again, as large, as small as your local company, and as large as like a local restaurant or hairstylist, and as large as IBM and Apple and Nestle's, they all have statements of cash flows. It's just much larger numbers, but it's all the same concept. So that kind of wraps this up. The first part is the income statement and balance sheet. Then we talked about retained earnings. Then we talked about statement of cash flows. What I would tell you is if you want a copy of my interactive spreadsheet, which would help you better understand it, please leave your email in the comments, and I will do that. If you're one of my students, obviously, just send me a note. Great talking to you. Love doing this. Love making people learn more. Thank you. Okay. So does that help? I mean, that's the most difficult. If you get that, that's the most difficult. If you get that, then you pretty much are pretty good with these things, because the income statement is cut and dry. Balance sheet, pretty cut and dry. Retained earnings, it's just what did I make and what am I giving back to my investors and what am I putting back into. Matter of fact, we have a word for that. We call it a plowback ratio. You don't have to deal with that, but that's in finance. We call it a plowback ratio because you're plowing back the money into your firm. That's what makes companies like Apple so effective. When you think about Apple Computer, you say, what's a great company? Of course, we know it's a great company. But what really makes it a great company is they come out with all this new stuff, new phone. We all know, anybody who wants a phone knows you got to constantly re-up it. I had my last phone for like 5 or 6 years. I was loving it, but I had to get a new one. But then they get new cash, and they just put the cash back into new product, and they come up with better products or new versions of a product. So really what they've created, we think of it as a company making phones and technology. I think of it like a cash machine. That's what they do. So you really start, when you learn accounting, you really start thinking about the books and records of a firm differently, like Costco. We went to Costco yesterday. We go once a month. I can tell you, I'm less and less in love with Costco because I have the local ShopRite, and I can find more things there, and I don't have to go traipsing all through the warehouse. And sometimes I wonder, now that I have Chat, Chat GPT, I call him Chat, the robot. So the other day I'm at ShopRite, and they're selling. In my house we use paper towels, like we eat them, I think. But anyway, we use them a lot. So I go and I said, they got the sale here at ShopRite. But we get it, what happens is we get trained, I'm going to get them at Costco. But when I took a picture and I ran the numbers, the robot comes back and says, you did better here because when it's on sale at ShopRite, you do slightly better. So obviously, then that's how I did it. That's how I went ahead. I said, I just buy the thing here and I don't have to go lugging it from Costco. And why do I bring up Costco? Because people think of Costco as a retail firm. I don't think of Costco as a retail firm. I think of Costco as a place that gives you a choice of one of every animal, right? You think about it, with the exception of coffee or a few other things, you get a choice of one with everything, right? You get a choice of one of everything. Then what they do is they turn over inventory because you're only buying one. So most of the stuff they sell, they're turning it over so quickly that within 9 days on average, now that's on average, because some things like, say, for instance, cinnamon might turn over 5 days, and I don't know, hot pepper might turn over in 12 days. But on average, they turn over and they know what they're doing. Believe me, their most important job is to have the stuff there that you're going to buy, even the prepared foods. And on average, they're turning it over every 9 days. But they're not paying for it for 90 days, 60 days. They're buying so much of it, they could tell the supplier, you'll get your money in 90 days. Now, of course, the supplier is thrilled because they're selling a ton of goods, but they got to wait their 90 days. Now, you do the math. If you're getting your money every 9 days and you're not paying for 90 days, it's a nice deal. I'll take that deal all day long. you'd be in that business all day long. So Costco is really not what we think of as a retail firm. What it really is a cash machine. That's what it really is. It's a cash machine. And many businesses work that way. Like, it would take me a long time for me to explain to you how, for instance, Wall Street works, because that's where I spent my life. But in many cases, people think of Wall Street as commissions. No, in most cases, they're lending you money to buy stocks, but they're protected on those stocks. So they're earning a spread between what they charge you and and the money you're leaving in the accounts. And that's another business that works for them. So you'll find in most, but like you think about when you go to the supermarket, there's a lot of that stuff. So the supermarket says, if you want to put your cereal at eye level so people buy it, you've got to give me terms. And they say, well, you pay us every 90 days. So the supermarket will say, okay, every 90 days. But what winds up happening is you're paying when you go to pay for this stuff. When you're in the supermarket, notice it's not every 90 days. You're paying, they're not paying the supplier for 90 days. But on the other hand, they may not be paying the supplier, but they're getting the cash immediately. You don't go and tell them I'm not paying you for 90 days. You're paying them that day with your debit card or cash, however you pay your check. So they're getting that money right there, and they're not paying for 90 days. A lot of times, these retail businesses like supermarkets and Costco are just cash generators. And that's where the cash is. And most businesses work that way. There's more to what you think when you look at a business. Like if you ever watch the documentary on McDonald's, everyone thinks of it as a hamburger company, and it is. But it's also was a real estate company. All right, we're almost done with the hour. I'm sharing now. Any questions before I shut this down? Any questions? Generally accepted accounting principles are the key words. Any questions? Could someone just tell me there's no questions? If there are no questions, you guys could leave, and it's a pleasure to do business with you today. Hopefully, I gave you not just the homework and what we're doing, but some answers. Okay. See you guys next week. And it was great having all of you here. So I hope you come back. It's really nice.
Thank you so much. Next
My
week. I'm sorry. Good
My pleasure. Really is my
Have a nice
pleasure.
one.
Thank you.
night,
Have a great
guys.
day.
Have a good one.
Thank you.